Are you tired of inconsistent trading results? Want to know the secrets to achieving consistent gains in the markets? In this video, we'll share the best trading strategies that top traders use to maximize their profits. From trend following to mean reversion, we'll cover the most effective techniques to help you build a successful trading plan. Whether you're a beginner or an experienced trader, this video is perfect for anyone looking to improve their trading skills and achieve consistent gains. So, what are you waiting for? Watch now and start trading like a pro. Trading in financial markets is a dynamic and challenging endeavor, often likened to a blend of art and science. Success in trading requires more than just luck or intuition. It demands a disciplined and strategic approach. This is where trading strategies come into play. A trading strategy is a systematic method of buying and selling assets, such as stocks, currencies, or commodities, based on predefined rules and criteria. In the fast-paced world of trading, consistency is the cornerstone of long-term success. Here's why having a well-defined and consistent approach is crucial. Markets are inherently volatile, and emotions like fear and greed can cloud judgment. A consistent strategy provides a clear framework, helping traders make rational decisions rather than reacting impulsively to market movements. A solid trading strategy incorporates risk management principles, such as setting stop-loss levels, determining position sizes, and diversifying trades. This ensures that traders protect their capital and avoid catastrophic losses. When traders follow a tested and proven strategy, they gain confidence in their decisions. This confidence is essential for navigating the ups and downs of the market without deviating from the plan. A structured approach streamlines the decision-making process. Instead of second-guessing every move, traders can focus on executing their strategy efficiently, saving time and effort. With a consistent strategy, traders can track their performance over time. Analyzing past trades allows them to identify strengths, address weaknesses, and refine their approach for better results. In the ever-changing landscape of financial markets, a consistent trading strategy acts as a guiding compass. It not only enhances the likelihood of success but also instills the discipline and confidence needed to thrive as a trader. Trading financial markets can be rewarding but is fraught with challenges that test even the most experienced traders. Understanding these challenges is crucial for overcoming them and achieving consistent success. Below are some of the most common difficulties traders encounter. Sudden price swings can lead to significant losses, especially for traders without a proper risk management plan. Increased uncertainty can cause hesitation or overconfidence. Employ strategies suited for volatile conditions, such as breakout or trend-following strategies. Overtrading occurs when traders take excessive positions, often due to boredom, overconfidence, or the desire to recover losses quickly. It leads to increased transaction costs and exposure to unnecessary risks. Frequent trading erodes profits due to higher fees and slippage. Traders may lose focus on quality setups and take lower probability trades. Set a maximum number of trades per day or week to curb excessive activity. Focus on high probability setups and ensure trades align with the strategy. Many traders fail to adequately manage their risk, either by trading without stop-loss orders or risking too much capital on a single trade. Overexposure can lead to significant losses and erode trading capital quickly. A few bad trades can wipe out weeks or months of gains. Inconsistent risk management creates unpredictable outcomes. Follow the 1-2% rule, risking only a small percentage of capital on any single trade. Use stop-loss and take profit levels to define clear exit points. Trading without a proper strategy, plan, or market analysis often leads to poor decision-making and inconsistent results. Jumping into trades based on gut feelings or unverified information is a recipe for failure. Unprepared traders miss out on potential opportunities and are caught off guard by unexpected market events. Lack of research leads to lower confidence and higher reliance on external advice. Always analyze the market before trading. Use technical and fundamental analysis to identify trends and potential opportunities. Backtest strategies and simulate trades before committing real capital. Psychological biases, such as confirmation bias or loss aversion, skew decision-making. Traders may ignore information that contradicts their expectations or hold on to losing trades to avoid realizing a loss. Biases result in missed opportunities and poor trade management. Traders may overestimate the likelihood of success based on selective data. Keep a trading journal to review and reflect on decisions. Seek feedback from peers or mentors to gain an objective perspective. Many new traders enter the market expecting to become wealthy quickly, leading to over-leveraging and high-risk behavior. Unrealistic goals often lead to disappointment and burnout. Impatience leads to hasty decisions and larger losses. Constant pursuit of quick profits detracts from long-term growth and learning. Set realistic, measurable goals based on skills, experience, and available capital. Focus on gradual improvement and consistent performance rather than immediate profits. The challenges traders face, from market volatility to emotional decision-making, are formidable but not insurmountable. By acknowledging these obstacles and implementing disciplined strategies, traders can navigate the complexities of the market more effectively. Success lies in preparation, adaptability, and maintaining a level-headed approach. Identify and follow the prevailing market trend, uptrend or downtrend. Moving averages, trend lines, and technical indicators like the average directional index, ADX. Buy when the price is in an uptrend, higher highs and higher lows. Sell or short sell in a downtrend. Use stop-loss orders below key support levels or above resistance. Swing trading captures short to medium-term price moves within a larger trend. RSI, MACD, Bollinger Bands, and chart patterns, flags, pennants. Buy at support levels during pullbacks in an uptrend and sell near resistance. Place stop-loss orders just outside the anticipated swing range. Day trading open and close trades within the same day, profiting from intraday price movements. Candlestick charts, level 2 data, and momentum indicators. Use strategies like scalping, quick trades, or breakout trading. Set daily loss limits and use tight stop-loss orders. Mean reversion prices that deviate significantly from their average will revert to the mean. Bollinger Bands, moving averages, and standard deviation channels. Buy when the price is below the lower Bollinger Band, sell when above the upper band. Avoid mean reversion in strongly trending markets. Breakout trading trade the momentum of price breaking through key support, resistance levels. Volume analysis, consolidation patterns, triangles, rectangles, and VWAP. Enter after a confirmed breakout with strong volume. Place stop loss below, above the breakout level. Avoid false breakouts by waiting for confirmation. Position trading long-term strategy based on fundamental analysis and macro trends. Economic indicators, earnings reports, and industry trends. Hold trades for weeks or months based on expected long-term price movement. Adjust position size to accommodate larger stop-loss distances. News-based trading trade based on market-moving news, earnings, economic data, geopolitical events. Economic calendars, news feeds, and analyst reports. Enter trades immediately after news releases, focusing on high-volatility instruments. Use wider stop losses during volatile periods. Algorithmic trading use automated systems to execute trades based on predefined criteria. Trading bots, custom algorithms, and APIs. Develop or use algorithms to identify and act on trading opportunities. Regularly monitor and update algorithms to adapt to market conditions. Risk management techniques set stop loss and take profit levels for every trade. Never risk more than 1–2% of your account on a single trade. Diversify across different asset classes and markets. Backtest strategies before implementing them in live markets. Keep a trading journal to analyze successes and failures. Stay updated on market trends and refine strategies accordingly. Trading is an exciting journey, and the beauty of it lies in finding the strategies that work best for you. Now, we'd love to hear from you. What's your favorite trading strategy? Is it trend following, swing trading, or perhaps something unique to your style? Drop a comment below and share your insights with our community. And if you're ready to take your skills to the next level, don't forget to check out our next video on advanced trading techniques. You'll discover powerful tools and strategies to elevate your trading game. Let's continue this journey together. See you there.